Howdy, happy new year to all the great Apex Advice clients out there. Hope your festive season was a great one and I'm looking forward to smashing it in 26 with you. So over the next sort of 5 minutes, we'll run through your December quarter market update, looking at how markets performed, a little bit of commentary on what happened in markets, as well as looking at our proxy, the Vanguard High Growth Fund performance, and then finishing off with a bit of a conversation around diversification. So the December quarter was certainly a strong one for financial markets, with most regions finishing in the green. AI remains the AI and the AI thematic is a big driver and remains lots of optimism on what it'll do surrounding corporate profits and global growth from here on out. However, as we do wrap up the year, the market is becoming a bit more discerning of the winners and losers of the AI trend. So we're seeing a company like Nvidia, which is now the largest company in the world, overtaking Apple as a clear winner in that space. Looking at the US and the UK, so rate cut and inflation over there, both those economies did reduce rates in those regions for the December quarter, as their inflation either remained as expected or some softening of it, as well as some softening of other economic indicators for them. However, locally in Australia, the RBA has held rates, and this is due to inflation being a little bit sticky and than what they were hoping. We saw some trade policy continue to be a focus for global markets, and that was rammed home later in early January, actually, by the US actions in Venezuela. What does all this mean for global markets in the short term? Most certainly, we'd be expecting a bit of volatility around commodities and the stock market as well. However, the long-term impact remains to be seen and remains to be proven. The continuing message from us at Apex is, of course, reach out to your advisor if you do have any concerns. Otherwise, stick to your investment strategy of continuing to invest in great businesses on a regular basis throughout the ups and downs. These cycles are certainly normal, and your timeframes will take care of the upside. So looking at the stock market for the December quarter, again, through the lens of the Vanguard High Growth Fund, which is a 90% growth investment portfolio, and it's certainly a good proxy for global share markets as a whole. So what we saw was an increase of approximately 1.3% for the December quarter, and the 12-month period was up to circa just shy of 13%. So very strong year and above the long-term averages, which you can see around that 10-year mark is sitting close to 10%. So that was very good. Next up, just having a look and wanting to lift and dive under the hood and get a little bit more granular at those numbers. We saw the S&P 500 increase by +2, Euro Stocks 50 +4.3, the FTSE 100 in London +5.8, and then locally on our shores, the laggard, so ASX 200 -1%, the Euro market being the real driver for that quarter. Zooming fully out for the entirety of the 2025 calendar year, we can see that volatility early in the year because of that US trade war, the tariff war Donald Trump had. And what we notice from that is that the markets have well and truly recovered. And as such, the patient, consistent, and opportunistic investors were definitely rewarded. And really noting that China and the US and Europe all finishing the year particularly strong, and the Aussie market lagging behind in that back end part of the year. Now, that's a good segue into this concept of diversification. It's not only a buzzword you'll hear us banging on about here at Apex, but something we're quite serious about. So our portfolios are generally very diversified across regions, stocks and businesses, and different sectors as well, which is here on this screen. So what this means is that the growth drivers of your portfolio are not pegged to one news flow, one headline, or one thematic in global markets. We often talk about asset allocation being the predominant driver of returns, and your portfolios are very well diversified. And what that means is your wealth creation journey depends on a lot of factors in global markets, as opposed to just one granular thing. What you'll see on this chart is that financials and information technology make up circa 20% of all portfolios, with the remainder really spread across multiple industries and multiple sectors, which I'm sure you can appreciate. Having multiple drivers of your portfolio is helpful. Just wanted to again help us remember and connect with what we own in the businesses. So regions and sectors are one area of diversification. Clearly, the US is the largest market and is the heavyweight in terms of financial markets in the world. But if we look under the hood, the businesses of most of the top holdings sit something like this, and they're very spread and diverse. So this is approximately 10 to 15 of the largest holdings in the world, and it makes up circa 20% of most portfolios that are held. And the importance here is to connect with what you own. They're all recognizable businesses, and noting that the rise in many of these are through A companies, particularly Nvidia and even Goodman Group, who are dipping the toe there. And what's dropped out are some names in Australia. One more thing, I came across this chart in my travels and I thought it was a really good one. So basically what this shows is that you don't need to be on hand trying to pick the winners year on year to do well. Owning broad-based funds like we do means your portfolios always own the beasts and the best businesses out there. And it takes the guesswork out of your portfolio management. So this just shows you year on year the top 10 of the S&P 500 year on year. That's it for today, guys. Hope you're well, and thank you for tuning in. Looking forward to chatting to you in the next quarter.